Hello, everybody. Chris Martinson here, and today we're going to be talking about finance and economics as part of Finance U. Remember, anything that you see in this video and all resources available at our websites or affiliated websites are not intended as or construed as financial advice. This is for educational purposes. Remember, if you have a financial decision, please consult a financial professional. We are not attorneys, we're not CPAs, we are not financial managers. As well, we do our best to be accurate, and everything we represent is as accurate as we know it to be. Now, let's turn to our program.
You're talking about federal government bankruptcy, you're talking about corporate bankruptcies, you're talking about really bankruptcies on a global scale, which is truly an absolute reset, right?
Hello, everyone. Chris Martinson here of Peak Financial Investing, also Peak Prosperity, here back with another episode of Finance University. Paul Kiker of Kiker Wealth Management. So good to be back here with you today.
Good morning, Chris. It is a pleasure. I always look forward to it.
Me too. People are really responding and saying they like these series, that they like to learn, and there's so much to discuss. And I think we're about to enter a really troubling period of financial disruptions is the kindest I could put it. We could be facing a crash. So here's the setup. Things were really crazy in 1995. So the Fed jumped in, right? And they did this thing which enabled banks to go to effectively 0% reserve requirements. And then we had this whole thing called the internet craze, right? Dot bombs, it was all about eyeballs, pets.com, long-term capital management, bailout, crash, right? But then Ben Bernanke comes in, bailout, housing bubble, crash. And then from 2009 to 2019, it was just one bailout after another. There were these little hiccups in 2011, 13, 15, 17, like every couple of years. And the Fed would ride in because, relationship goals. You want to find somebody who loves you as much as the Fed loves the stock market.
That's right. That would be the perfect spouse. There's no doubt about that.
Right? But it was clear. They kept saying, oh, dual mandate, full employment, stable prices. Like, no, every time the stock market wiggles, they would ride in, right? But 2019, things are going wonky, really wonky. We had the repo market blowout. Overnight rates were going. I know this is wonky plumbing. Most people don't care, but it was really important because it showed that something wasn't good down there. And the Fed started printing money again. And then, COVID. And they got to double their balance sheet. That was $4.5 trillion of new money that was just powered into the markets, and everything went a little crazy as a result. We have inflation now. People can't afford Big Mac, restaurant meals with their family anymore. Why? Because of the Fed printing to bail out Wall Street, who needed a bailout from the bailout that was to bail out the prior bailout, which was a smaller bailout. And that's the story. It's just larger and larger shenanigans, all to try and keep this can in the road as they kick it down. But they never had a plan, Paul. That's my view. They never really had a plan to say, then we'll undo this when what?
Right.
It just never came. So here we are. And I think we're seeing signs now that things aren't okay. And I want to talk about those today because I think people and their portfolios, they should be ready for this.
Correct. And as far as the baby boomers, they've approached retirement and come into retirement with this, just do whatever it takes. We're going to bail the markets out at any expense. And they've become complacent. Wall Street has become complacent. If you're a money manager who's actually tried to apply wisdom to your process, it's not worked because, all the financial media talks about is the benchmark. And people, what I'm seeing for the average individuals who aren't working with someone who takes the time to go through a plan, talk to them about the strengths and weaknesses, is they don't have proper asset allocation. And they're chasing the S&P 500. They're overweight the S&P 500 because for 10 years now, no other category has provided any returns. So let me share a screen here. Let me make sure I've got it just to kind of
one small correction, Paul. Is it the S&P 500 or is it the S&P 7?
The S&P 7, specifically lately the S&P 7. It doesn't show my window here. Let me see.
Because, while you're finding that, the most recent charts I've seen show that 493 companies in the S&P 500 have earnings erosions of double digit. And so normally when you have that, you have some sort of a recession in the stock market, but you don't right now. You have actually all-time new highs at the time of this taping.
Yes.
And what is taping? Kids today won't even know. What do you mean taping? What is a tape, right?
That is true. Well, and another analogy while we're pulling this up, can you see the...
Yeah, I sure can. I can see that now.
So,
But yeah, I mean, normally you'd have an earnings recession, but we're at all-time new highs, and that's really just because of the Magnificent Seven, the Nifty Seven, to harken back to the Nifty 50. So
That's right.
Take us through this chart. What are you seeing here?
So what this is this is just your major investing classes going back to January 1st, 1998. So the black is the S&P 500 index. The blue is the commodities index. That's the GNX, the Goldman Commodities Index, which is 8% below overall what it was January 1st of 2008.
Wow.
The red is the MSC Developed Markets Index, EAFE. So that's about 1.1% below what it was January 1st of 2008. And then you've got the Emerging Market Index, which has just been absolutely decimated. Now, for the investors who recognize this distortion in the overall market, from that bottom in 2020 at COVID, you had a nice little surge that occurred in commodities as the market started to sell off. And then all of a sudden, we're back to this Pavlov's dog where, Magnificent Seven has pretty much carried this entire rally from this point forward. And there's a lot of weakness under the surface. So, one analogy that I like to use, Chris, to kind of share is, let's say we're going to battle. Okay, we're a part of an army in a battle, and you've got the generals. So there's no doubt that the Magnificent Seven are the generals. That's what everybody's paying attention to. Big investors and institutions are forced in there because their benchmark is the S&P 500, and they have to be allocated to that. So at this point, what we're seeing is the other 493 stocks. Let's consider those as the infantrymen, right? So we're on the front lines, we're fighting. And all of a sudden, the generals realize they're the only ones on the front line fighting, and the infantrymen, everybody else, has exited the battlefield. Well, it's highly unlikely you're going to win that battle. So, we're starting right now to see under the surface in the NASDAQ 100 some deterioration and some weakness. In the Magnificent Seven, Tesla is starting to deviate from the performance of the rest. Of course, this morning go ahead.
And a point on that, which I want to make, which is that the blush is well and truly off of the EV rose in this story. Everybody electric cars. Remember the narrative for a while, which is like, you're not buying a Tesla, you're buying a future self-driving car that's a capital investment that's going to make its own money back because you can just send it out to pick people up and drive them around. That was the story. Obviously, self-driving was more complicated than that. But beyond that, we're seeing that Ford and GM, they're just admitting outright they're just losing money on all these cars. We know that Tesla actually lost money on every car it was making for a long time, right? But there was plenty of money for the story, and that helped carry it through for a period of time. And they've turned profitable, but now people get it. Electric cars, the blush is off that. Like, people aren't scrambling for those. And if you look at the sales price, the resale price for a used Tesla, it's just plummeted, right, by 50% or so. I mean, you can buy a used Tesla Model 3 for 30, 40 grand, where the purchase price is twice that. So at any rate, I think that, yes, there's clearly some tough signs in the EV market. And now people have found out that all the public money they spent on EV buses, those didn't work out at all, right? So the whole thing turns out it wasn't as easy as we thought. And there's some complexities. Welcome to reality. Realities come to the EV market. Carry on.
It seems that, just kind of in summary, that the leaders, it's kind of like your intellectuals on the education side, that they have these great theories, but the application of their theory and reality doesn't hold up to what they're promising it to be. And this is just a common theme that continues to come,
It's
be
true.
delivered down from the elite. So
it's true. There's the idea, and then there's the reality. Hey, let's make shoplifting a felony at $950 and over. What could happen? Oh, why are all these stores leaving my city? Right? They can't,
Right.
and they can't get those. Those two dots are like two north ends of a magnet. They just can't quite get them together.
Right. And what amazes me is I always come back to that one scripture. I always think about it, just the wisdom in it. And I can't tell you exactly where, but I know what it says. There's a way that seems right to a man, and in the end it leads to death. Now, of course, that's a statement that can be true at the extreme, but it's also true in all of this theory and overhype of what's taking place, and the application doesn't meet the standards. They're just so detached from what's actually taking place.
Yeah.
And, and I had some individuals around here that were so excited about buying that Ford electric vehicle, but it's not lived up to their expectations. So, there's just a lot taking place under the surface. So you've got Tesla that's starting to crack. This is going back to your theme in the fall of last year, creaking and poppings taking place around the edges. Now, we had a relief of that with this Fed-induced euphoria or panic purchase when they, first November meeting, do a 180 and go from higher to longer to Fed rate cuts. Well, since then, markets have accelerated. We've hit all-time highs. Financial conditions have been easing relatively dramatically. We talked about that last week. That's a pretty big deal. And going into March, we've got about a 50% odds. The market's estimating a 50% odds of a Fed rate cut. But the question that everyone's asking, who understand what's taking place under the surface, is, if the markets are at all-time highs, the economy's holding up as good as what they say it is, financial conditions are this loose, which means that banks are willing to loan, all institutions are willing to loan to basically anybody who's willing to sign the dotted line. Does it make sense to cut rates, and does that not run the risk of inflation surging back again, especially when you've got, the Red Sea issues and the shipping issues? Rates are going up. That's a supply chain disruption. That's more cost that's coming in. And then, on the other side of that, you've got UPS laying off a lot of individuals here after this labor deal, which, you could see that coming, right? Just especially after the incredible labor cost that comes out there. And then another side, I was listening to an interview with Grant Williams and Mike Green and another Mike that's in there, and just a different perspective on the immigration crisis. At a minimum, of all the problems that are out there, this has increased labor, for example, which is driving wages down for the middle lower class. So how in the world are we going to continue this ridiculously euphoric market when you've got leading economic indicators that are still continuing to contract? So just to kind of bring that up.
Well, and yeah. Let me make a quick point, because I was this came into sharp focus. I was being interviewed by Kim Iverson about this migrant issue, because I was just down in Panama, and so I have a new perspective on this, and in this invasion that's happening, right? So let's talk about this, because this is actually something they don't want to talk about. They want to make this seem like it's left-right. It's either a Democrat or Republican issue. This isn't. This is an up-down issue. So the people at the top, who are on the up, right, the elites making these decisions, they say it's, because we care about these people so much. They don't care about the people, right? They make them go through a really hazardous, if not deadly, journey. There's a lot of crime and rape and stuff that happens along the way. So they make them go through this awful gauntlet to get here. And when they get here, these people, remember what happened when 50 migrants were shipped to Martha's Vineyard? Mm-hmm. That was hysterical. Martha's Vineyard rallied its plucky little, self. And within hours, all these people were shipped off the island with these wonderful people with their sun hats and mimosas, saying, we care about these people so much. But they just off they went. So the point that Kim made, though, is that all these people, 22 million people illegally in the country as of 2018, another 10 million since then. Where that's like 3 Houstons, right?
Yeah.
They don't end up in Martha's Vineyard. They don't end up in Greenwich. They don't end up in Shaker Heights. They end up in places where they have to live somewhere. So they are now competing with poor people in this country, typically, right? Poor and lower middle class. So that's the competition. So it's not good for that end of the thing, but it makes the statistics look good because, look, wage pressure is coming down, right? it's not good for the people who are migrating ultimately, and it's not good for the people who are already here. So I just want to say this isn't a left-right issue. They
No,
try and frame it that way because they want us fighting like rats in a cage, but it's not it. This
no.
is these people against these people. And these people, by the way, when they pump their markets up, let's be clear, 92.5% of all equities are held by the top 10% of households and wealth. It's like, these are the sorts of things that Plutarch, thousands of years ago, said the oldest and most fatal ailment of all republics is a gap between the rich and the poor. So these policies have impacts. I just want to point that out again. I'm not a bleeding heart egalitarian. Everybody has to be equal kind of. I'm just saying though, these policies are really shaping my bearishness at this point in time because they just keep pushing us in a direction where I'm like, tell me how this story ends. Like write this. Give me the rosy ending. Like, how's this all work out? But I don't know that they're thinking that far ahead. So carry on.
That's a good question. Well, and my great concern is just the euphoria, the positive news that's out there for the average retail investor, this fear of missing out. I mean, there's a lot of individuals who just didn't understand what was taking place. So 2013, 14, 15, even many in 2008 just decided to exit the market, right? Like
Yep.
they don't know how to navigate this environment. They don't have the tools. They're trying to balance their career and deal with their investments at the same time. And this market just continues to go, right? Like, so people are hearing all of the potential risks that are out there, and they're real. Valuations are high from a historical standpoint. I mean, outside of 1929, we haven't seen stocks this expensive. Now, from an education standpoint, price to earnings ratios, if we go back to these valuations, why in the world would investors spend time applying these valuations? And the reality is, when we buy a stock or an individual investment or an ETF or a mutual fund, you're buying all the stocks that are in that basket, all the stocks that are in the S&P 500. So your price to earnings ratio matters because all you're paying for is the future earnings of the company. Now, the problem with these euphorias that we're in right now, let's take Amazon, for example, just to pick an example, and I'm going to be general because it came to mind, so I'm going to talk about this. This isn't exact, but in the late 1990s tech bubble boom, Amazon was one of the leaders. Stock went up, had dramatic returns during that period of time. Investors could see the application from a long-term standpoint. So let's bring that back to artificial intelligence today. People can see the application from a long-term standpoint, but I know some people have used it successfully. Other people's are still struggling. We know this is going to make a big impact, but the euphoria at the end of this bull market that's taking place here, going back to the Amazon example, investors were right. I mean, from 2000 until today, it's been given an incredible return for those investors who've been able to stay there 23 years later. But when the tech bubble burst and reality came back, Warren Buffett, who had underperformed in the late 1990s, outperformed in 2000 to 2003 because investors were like, okay, we've been too euphoric. And if you go back, I could build the argument that the media and Wall Street used their influence to offload all of these to the retail investor, because the retail investor tends to be left holding the bag. So if you take that today. Now, to finish that line of thought, Amazon didn't get back to those 2000 highs until 2013, 14. So how many investors had the courage to continue to average in that stock over that period of time? Very, very few. And most investors would have given up on statistics show us that investor would have given up on Amazon, because 13 years is a long time to hold something if you don't understand why that stock, dropped so much and took so long to come back. So where we are today, this momentum may carry on into June or July. I wouldn't be surprised to see that. I also wouldn't be surprised to see a pretty strong correction here in the short term, just because we've got some selling that's taking place under the surface. The NASDAQ's starting to crack. Tesla's starting to crack a little bit. But all of this euphoria that's out there in the financial media just reminds me of what I saw with bank stocks in 2008, tech stocks in 2000. The major media is like, don't worry, this is going to be great. And those investors just panic buy because they end up investing like the hare in Aesop's fable because they don't have a strategy, they don't have a plan. And anybody in the industry that has a plan and a strategy has essentially been painted as a pariah because, the Fed's been able to bail out the markets consistently and created this everything bubble.
Well, they have, and they've been doing it over and over and over again. And so people could be absolutely forgiven for saying, you know what, I think they're going to keep doing that.
Yeah.
They'll bail it out one more time. Can you pull up that chart you had of the long term of the S&P again?
Yes.
I think it was one with Hussman where you were showing some of the moments there.
It is. So Hussman in his most
So
recent.
yeah, this one. Let's look at this one real quick. I mean, that is just a straight line. I know it wiggles and it goes down and everything, but pretty much you could put a ruler under that from left to right.
You really could. From the 1929 low all the way up. So, this is a chart that Hussman put in his most recent market comment, the return of buy low, sell high. So, after reading the whole article, I'm still not exactly sure where he came up with the title, but basically it's, this is a point where you want to look from an investor that's patient from a long-term standpoint and has a strategy to have your exit plan in place and potentially sell high, because that's what we want to do in application is buy low and sell high. So what he does in these highlighted areas here, he goes back all the way to 1929, and he highlights periods of time where the market's overvalued, the undercurrent of the market, let's say the generals are leading when the infantry has left the battlefield, and what has occurred on the other side of that. So, for example, from July 1929 to 1950, the S&P 500 total return lags Treasury bonds during that period of time from this peak right here. Okay, so you're talking, so that's 21 years. And that's what I'm more concerned about. We don't know how bad this will be on the other side. Let's go back to the year 1998-2000. So during this period of time, and that's where Hussman did a phenomenal job of just warning investors that something's coming. And, and then the market cratered, right?
Mm-hmm.
But the intervention led to the housing bubble. We reached those levels again, market cratered. Intervention continues to go down, and now we're starting to reach these extremes, and and they keep kicking the can down the road. My argument is, I think his argument is, not putting words into his mouth, but just what he's saying is this is a period of time where investors can have decades of return, potentially 10 years of return wiped out because the market's in a euphoria, the everything bubble, and it's just way ahead of what the long-term earnings capability is of the overall market. So even if we go back to 1967, 1968, we slightly got, we were expensive for this short period of time, but if you look at the index, it was basically flat with a little bit of a breakout in 1973 period here, all the way out to 1982. So what's that going to do to the average investor, the average baby boomer, the average retiree? Now, if you're 30, it doesn't really matter, right? If I'm 30 years old and I'm not going to retire till I'm 65, this is the best thing that could ever happen to you, right? Because if you're dollar cost averaging into the market, if the market goes down, you're buying more shares. Market goes down, you're buying more shares. If it's here, if you're 30, best thing that could ever happen to you, you're buying more shares. But what happens if you're 65 and you just retired? You've got a completely different set of risks. So if you don't have a risk managed process in place, or you don't have the wherewithal in your portfolio to weather 14 years of the market going sideways, and you're taking distributions, well, guess what? If you've got $1 million portfolio here, this is an extreme example for educational purposes, but if you've got $1 million portfolio here and you're drawing 50,000 off of it, well, by 2003 bottom, guess what? Didn't drop quite this much, but for the educational purposes, now you got $500,000 portfolio and you're still taking 50,000 a year off. Well, guess what? That's 10%. So the market makes 10% into 2007, and then that next decline wipes you out. So what concerns me the most is our government has set up a situation here to where, let's hope it's not as bad as 1929, okay? But this is a period of time where it's highly likely that the markets are sideways for the next 5, 7, 10 years outside of hyperinflation, and what is that going to do to investors who aren't prepared for that type of environment? So it
Well,
sets up
yeah,
a very dangerous circumstance.
I agree. And so my perspective, I look back at that, and it's very tempting to say, look, the past 100 years should be a reasonable guide for the next 100 years. But let's talk about some things that are slightly different. And I know that this time is different, are dangerous words in investing, but it is a different environment. So from that 70 to 83 moment where it was kind of flat, right? Well, what happened? Well, we came off the gold standard right in the middle of that, right?
Yes.
And so let me see if I can share this screen. Why does this? This is going to be this one. I'm going to share this one. All right. So let's take a look at what happened back here. This is total federal debt. This is just debt held by the public, right?
Mm-hmm.
But this is where the federal debt started going up and up and up. And notice it's just really like spiking through here. And then here at this great financial crisis, this is where it really took off. And then it really took off around COVID. And so you can clearly see, if you look at the shape of this isn't a straight line, Paul.
No.
This is what we would call an exponential or a nonlinear line, right? An exponential curve fits pretty tight. So we're going to spend more and more and more and more. In fact, Peter St. Onge just had a great point. He said, yeah, hey, we just had this really great 3% recent GDP reading. But that's in the context of nearly 10% deficit spending by the federal government, right?
Yes.
Which is not good, right? And you can't do that forever as a household, as a corporation, as an individual. But that's what's happening, is this just spending more and more and more. So that's gotten locked in. So this time different? Is it true that maybe, we can't do this sort of incredible, increasing deficit spending forever? I would suggest we can't. 2, we also know that, during post-World War II, we had this great economic boom. There was this whole industrialization. We built the highway system. We had all this oil that we were able to prosecute. We had, lots and lots of energy. And then the internet came along and arguably really transformed everything, right? Which gives you more leverage so that Greenspan could come out and mumble his, productivity. What he didn't understand was productivity is I don't know why I'm sure he understood it, but this was dumb. Productivity is output by input, right? That's what it is. So GDP's up, but the input is your labor cost. We outsourced all the jobs to China, but kept all this stuff going by deficit spending and debt explosion, household debt, corporate debt. We were borrowing more to make the GDP look good, and we were using fewer people because all those jobs actually went away. The highly productive manufacturing jobs, we replaced them with Uber drivers and dog walkers and all that, right? So it looked great, but it's a statistical mirage. But still, we were able to persist that mirage. Now, my question is, and again, I'm prepared to be surprised. I don't want to be overly bearish, but what's the engine for growth? What's the story? The story now is it's AI. And I agree, AI could really make things efficient, but not for the average worker, because what AI is going to do is put people out of work.
Yes.
It's not going to create more productivity, except for the people who own the capital stock and all that. But let me just be clear. AI is going to ruin the middle class and upper professional classes. Mm-hmm. No, we don't need lawyers anymore. We won't need accountants. We won't need all kinds of jobs that AI can just do better. Right? We won't even need content producers. We won't need script writers. We won't even need actors.
Right.
This will all go away. Right?
Right. I mean, especially just with the photo generating capabilities. I mean, when you really look out there, who's going to be left to buy anything? Or are we just going to be on a complete universal basic income if AI is that impactful, which it looks like it will be, with the computing power? And that reminds me of a Black Mirror episode. I recently,
doesn't it?
Yeah, I couldn't get through that first episode of Black Mirror, so I got into the second one, and it's like the modern day Twilight Zone. It's very thought provoking. But So, that's a good point. And going back to that debt, and just a reminder to the listeners out there is debt. All debt is bringing forward future purchasing power. You don't have the income today or the assets to purchase something. So you go borrow money from someone else to pull forward your purchasing capability to today, and then you spread that over time. There is a point of diminishing returns when it comes to that ability to purchase debt. Now, since removal of the gold standard, the government's like, oh, we're going to have inflation. It's good for you. Well, that increase over time, from their perspective, I think is like, okay, well, that brings forward more purchasing power in the future. Your income goes up. You set that down. But the reality is we've brought forward from a government level and individual level, if you look at total debt that's out there, a dramatic amount of purchasing power, and at some point we're going to hit a wall. My concern is the BRICS are not purchasing treasuries to the extent that they were before. So who's going to be buying? Who's going to fund this debt, right? Is the government just going to print it? At that point, it's going to potentially lead to hyperinflation, which is something an investor has to be prepared for now and have a plan in place in case the event that happens. And then second, about your second point there is diminishing returns, right? We shipped all of these jobs overseas that brought goods down, but what that's done is essentially an equalization of the nations, right? At some point, and I think we've already reached that, wages start to go up in those other countries like China, whether it's Mexico, because we've got a lot of manufacturing coming back here, and that drives down the income capability of the U.S. Well, with all this debt, there is diminishing returns. It's kind of like in the farming industry, you have big, institutions go in and buy farmland. Well, I don't blame them because they've got the capital to do it. They drive their prices down to try to gain a share of the market, but at some point those prices can't go any lower because farming doesn't become profitable, and then prices skyrocket. So in nearly every sector of our economy right now, it's like holding that basketball underwater, and we're so close to the point that the hands are losing the grip on that basketball, and we're going to have a dramatic amount of changes in a very short period of time. And the investor that's not prepared, that doesn't have a strategy, that is going to get wiped out. And the investor who thinks that anybody can navigate that perfectly. Nobody's going to navigate it perfectly. What you're going to have to find in your approach to this is understand the strengths of an approach and understand the weaknesses of an approach so that you can emotionally stay the course, because nothing's going to navigate it perfectly because we're in completely uncharted territory. I mean, there's really, especially in the U.S., we're in completely uncharted territory right now.
Well, I love talking with you about this because I agree with all that. And the first chart you started with, where you showed that, gosh, since 1998, commodities really have actually slightly lost ground, Yes. That's an unthinkable proposition to me. That's what happens through financialization. This is the orientation I would love to bring to people, this orienting thought process, which is that what we're experiencing is not reality. What we're experiencing is a heavy distortion of reality that's brought forward by financialization. If you read Will Durant's incredible tomes about history, I could read you a paragraph out of Athens from about 30 BC where they went through a giant debasement of their currency, and it sounds just like today. Like all their best and their brightest actually spent more time trying to figure out how to make money with money. Gambling came up, all sorts of vices, debasement led to debauchery. Like there was all your society crumbles. But people respond to incentives. So if it turns out your choices are start a business, have to manage employees, supply chains, risk, market risk, building products, competition, or I can make 10 times that amount by taking my same brain power and flipping some keys over on Wall Street.
Yeah.
This is an easy decision to make, right? Your best and your brightest go here because we're humans and we respond to incentives. So
yes.
The Federal Reserve is, in theory, should have had at least a few people over there who understood moral hazard and how humans behave. Because what they've done, Paul, is they've created a system where all of our best and our brightest, not all of them, but a lot of them, are over there chasing this financialization, and along the way, we're not really setting up the future prosperity, right?
Correct.
And so, When I talk to people who are in the oil patch, I mean gray hair, 40-year experience types of people, right? They tell me that we're at the end of that story, clearly and inarguably. That it's now harder and harder and we're chasing less and less, but we're pretending as if that's absolutely not the case, right? And the implications of that are profound, which is why I think between here and 2030, people are going to have to we're going to have to be nimble. We're going to have to really do our level best to understand what's the noise, what's the signal. And that's going to be really hard for people to do because we have 30 years where the noise was the signal.
Yes.
Right? And that's hard to get out of.
It really is. And, and going back to the business and starting a business versus going to Wall Street, I can tell you this. I left corporate back in end of 2003 and went independent. We have grown fast enough to, by God's grace, to stay ahead of that guillotine of government regulation. Mm-hmm. But it's heartbreaking to me today because there are so many regulations that have been implemented into the industry that I'm in that would have raised the barrier to entry that there's no way in today's environment that I could have replicated that jump to go independent. So, and my argument is this, yeah, some regulation is good, but what I'm seeing across a lot of industries is the barrier to entry has been raised so high. And it's not about protecting investors. It's not about protecting consumers. This is about big corporations using their lobbying power to raise the barrier of entry so that they can get an attempt to monopolize. And look, don't get me wrong. That's a part of what business owners do. I don't necessarily fault the business owners for trying to do that because there's no integrity in it. Mm-hmm. But it's understandable because their focus is to grow that business. Their focus for the shareholders is to grow the business. But the counterbalance to that is supposed to be politicians who are serving the American people and saying no to these contributions mm-hmm. and these buyouts that'll stand there with the integrity and say, look, I get it, but no, okay? There's a limit to your business. Find another way to grow. We're not going to do it through regulations that are really only designed to protect your business. So that's the frustrating thing. And you think about just how disheartening that is to young men and young women who have a great idea and they go out there to try to implement it and, they need to borrow money. They don't have access to Wall Street. If they do go to Wall Street, they get bought out, right? Somebody else offers them, a lot of money, or they drive them into the ground and then take over the idea and run forward with it. So, we need that political environment. And my argument that I talk to individuals about, and you do too, you spend a lot of time educating people for this. On the other side of this is going to be great opportunity for those who have the courage to look at the mm-hmm. world with truth, have a strategy in place, and understand why they're doing what they're doing, because the path less traveled is harder to walk. It takes a lot more emotional strength, but that's where the real joy is, right? Mm-hmm. We look at these individuals who took that path less traveled and we celebrate their success, and we forget the sleepless nights they had and the discipline that it took to stay the course and put their emotions under control and understand why. That's why a plan's so important and the strategy is so important. They're doing what they're doing because the end result will be worth it. It will be. So those of us out there that are looking at this, this is emotionally frustrating and we shake our heads and we fight as hard as we can. But on the other side of this is great opportunity for those who stay the course.
I totally agree. And, important piece of framing that I bring out all the time is that we have to distinguish between types of wealth, right? So mm-hmm. primary wealth, right, is, well, you have a farm, I have a farm. My primary wealth is the water, the fresh water that comes down in the soil, right? It's just, if I lived in a place with no soil, no water, Arizona, I would have a very different base of wealth that I could operate from. And then secondary wealth is turning that soil and water into beef and chicken and vegetables and things like that, right? And that takes effort, right? But that's the real wealth. And then tertiary wealth is stocks and bonds and paper and all this other stuff, right? Mm-hmm. And there always has to be a relationship between that tertiary wealth and the primary secondary. So as we look into this, secondary wealth is the means of production. I truly believe when you talk about the opportunities that are coming. So young people often say, hey, Chris, given all this, what should I do? Like, invest in yourself, get your skills, knowledge, work with people who understand, how to actually get things done, not this fantasy world of becoming a TikTok influencer or something. That could go away, right? The skills you have are really important, and the most important skills are how you take primary wealth and turn it into secondary wealth. That never goes out of style. No matter what happens, stock market could skyrocket, crash, completely implode. This won't matter. This will always be the same. People need primary, secondary wealth. So that to me is the great pendulum of life. We swing from things to paper. And it's happened so many times in history. And paper, in this case, is the representation of just trying to print your way to prosperity.
Yes.
Now, if you could print your way to prosperity, we'd all be speaking Latin because the Romans would have cracked that nut, right? They made cement things that we still don't understand, right? They were incredible engineers and architects and very thoughtful people. They, good luck, seeing if there's any American-made buildings of the 20th century in 2,000 years, right? Probably not, right? So I highly doubt it too. So that great pendulum, that's the piece where, we're swinging from things to paper, but within that paper world, there are still things that represent and tie back to real fundamental stuff. That's why I happen to like, and this isn't investment advice, just educationally, I like real stuff, right? Because it's out of favor. It'll come back in favor again. The pendulum always swings. And that's kind of the framing I would be looking at, if with a longer horizon in particular, is the primary, secondary always comes back into favor, because that's the stuff we really need. People need food,
Yes.
shelter,
Yes.
etc. Basic stuff.
And regardless of what the elites are trying to say, we need the ability to produce food and goods and things that we need on a regular basis. And just to go back to that screen again to reference that.
Yes, please.
So, this is 2008 till today. Look at where commodities are. Now, I'm going to go through and reference one other period of time in history. So this is 1990 to the year 2000. Now, I don't have daily data on these indexes going back prior to 1995, 1996.
Yep.
But it gives a good representation of the same thing. So guess what? Chris, we've been here before, right?
Mm-hmm.
I mean, from 1995, the market was sideways, and then we had this ridiculous momentum, and then the market started to crater with the fall of long-term capital management in 1998. Government bailed us out. Then they were, keeping rates low because they were scared to death of the Y2K bug.
Yeah.
And the market started running, started to roll over. It gave us one warning here that this was in, and then poof, we went up to new highs. Well, look at that. Investors here were just decimated. Now, what happened on the other side of that? So this is January 1st of 2000 through December 31st of 2007. So that black line is the S&P 500, right? So you had a 50% decline, and it did nothing for 7 years. But for the investor who was nimble and patient, the commodity index was up 213% over that period of time, and emerging markets were up closer to 155. So, there is historical precedent when we reach these extremes. Just to reference that again, we are at an extreme now. At this point, it's not as extreme as what the 1990 bull run was. And who knows, maybe we get another 6 months and the market's up another 20% after a 10% correction. I don't know how this is going to end, but we are much closer to the end and a rebalancing, okay? Because, what happened in the late 1990s is all of a sudden, when the market started cratering, institutions started removing into those lower valuation asset classes, and over the next 7 years, they made a dramatic turn. So, it's important that you have a strategy that will give you the ability to make those adaptations. And this is not necessarily a recommendation. This is not a recommendation. You got to talk to a financial advisor. But, you can average into, say, through a 401k or retirement plan, these underperforming categories, average into them. It starts to accumulate some exposure over that period of time. And you have an insurance type position or enough of a position to keep it on your radar. But you have a plan in place that when that momentum starts to change and when you start to see that money start to flow in other places because it's all supply and demand, then you overweight those categories or have a strategy that gives you confidence to overweight those categories, because that's more than likely where the greater returns are coming from over the next 7 to 8 years.
Now let me ask you a question that will separate you from probably most other financial advisors. What are your thoughts on gold in this context?
Okay. So again, you got to talk to your advisor.
Absolutely.
Gold is one of my favorite holdings, not a recommendation, but I really like gold from a long-term standpoint. Now, I believe that an investor that's appropriate, if you have an emergency fund in place, number one, and what amazes me, Chris, is I talk to a lot of people that don't have emergency funds because they're terrified of what inflation is going to do in that circumstance.
Mm-hmm.
But for those of you out there listening, you've got to have an emergency fund because it keeps you from being forced to liquidate a good holding at lower prices. So let's say, for example, you're all in gold, right? Now, not a recommendation. I'm just using an example for educational purposes. In 2007, 2009, gold dropped during the liquidation phase from 1,000 to about 700. Okay, that's normal because when the selling hits Wall Street, people are forced to sell anything that they can sell to cover their debts. You know, if you take GLD, for example, just an example, I'm not recommending GLD at all because it's not backed by physical gold across the board. Just as an example, your retail investors may be in there. Well, guess what? They're forced to sell or they panic selling because gold starts dropping. If you don't have an emergency fund to weather that period of time, what happens if you lose your job and you got to choose between selling gold at 700 an ounce or, you know, paying the mortgage payment or the rent payment or whatnot? So you got to have an emergency fund first. But then you have I like the idea of an investor having a 10% exposure as insurance from a long-term standpoint to gold. And from my perspective, at some point, if gold breaks out of this consolidation phase to the top, or if we get a liquidation and gold pulls back, I mean, I would not hesitate to go up to 30, 35% in gold and precious metals in a portfolio because our tools will allow us to do that. But we have to have the backdrop and the green lights across the board that's a prudent decision to make at the time. So I like gold. Wall Street doesn't like it. And in my opinion, Chris, I'll tell you why. There are a couple of reasons. One, it didn't perform well during the 1990s, you know, from 1990 to 2003. Really, from the 1987 top, it didn't perform well. So you had a whole generation that got burnt on expecting gold to do what it did in the 1970s. That's number one. So you've got the psychological side. Number two, it doesn't generate any fees for the big warehouses, right? Because when you buy physical gold and you set it there and hold it in your portfolio, or even if you buy it in an ETF, you know, like I like the Van Eck Merck Gold Trust, that's one. Or if you're buying it through Goldcore, for example, guess what? There's no fees generated for Wall Street. Well, you know, that in and of itself, and I can tell you from my experience in corporate Wall Street, they're all about our preferred mutual fund families, so they have to pay to play, right? Now, they'll disclose it to you in those 5,000 pages of reports that they send out. You know, it was better when we had 2 pages and it was a bullet point, but now it's 5,000 pages and nobody reads it. So they'll disclose it to you that it's pay to play, but that's just what's going on in Wall Street and in the corporate firms, and that's why we left and went independent. It's a harder path. I spent a lot of money keeping up with regulations, and we could be a lot more profitable if we were a corporate, but I don't have the confidence that we can do what's best for clients because, you know, go to any major warehouse and ask them, you know, if they'd, you know, would be okay with you putting 20% of gold in your portfolio. Again, not a recommendation, just a scenario. And the answer is going to be, you're crazy.
Mm-hmm. Yep. And it's because of the incentives, obviously, right? So right. Even if I hold, and I don't, but I'm just making an example of, let's say I hold shares in company A, right? I'll anonymize this. Those are mine. Mm-hmm. Actually, those are available in most portfolios to be lent out and collateralized, and somebody else can borrow them and short them. So even though I'm holding them, Wall Street's out there taking its little nips from it all the way along, even though I hold this, you know, it's just how It's all about that. That's why I do love working with you, and you would have to be independent because I don't trust the corporates anymore. Listen, they got incentives. They have their own incentives, right? And they say there's this Chinese firewall between their buy side and their sell side. But when your broker is saying, hey, and I had this happen to me, hey, WorldCom is a good buy, I found out later that was because their buy side was sitting on a ton of this stuff. Yes. And the bat phone picks up and somehow got across the Chinese firewall, and the sell side is busy moving product off of the, I just didn't trust the incentives, and I don't like to have to do all that digging before I can begin to trust somebody, and the same thing happened now with doctors and hospitals and, putting people on vents. And why did they put so many people on remdesivir? Oh, they got $3,000 from the government if they did.
Yeah.
That's a weird incentive. Was that best for the person? Now we know it was not,
No.
And so that is the system. We have to be very clear on the incentives. That's why I'm a full disclosure kind of person. I will tell everybody absolutely as a matter of policy where I stand on things and what I hold, what I don't hold if necessary. So you have to.
And one thing that you're great at, who was it says, I cannot remember right now, trying to come to mind, but basically, when the information changes, I'll change my mind. What do you do, sir? So that's the important thing. If we find out the information is wrong, we change our mind, right? You got to pay attention to the data. You have to follow the data. So one other thing I think that
was John Maynard Keynes in a Senate.
That's right.
Yeah,
I should have remembered that. But
yeah.
That's one thing I enjoy talking to you about. It's like we have so many topics that we cover. Sometimes I'm really struggling to pull together the individuals, but you do remember. So one thing I want to show you here is the screen, and I want to go back and talk about gold here, and let's talk about what Wall Street did. So can you see my screen there, Chris?
Sure can. Yep.
So basically, this is the exact same chart that I showed earlier from January 1st of 2008 until today in 2024, but I added a pink line. And guess what that line is, Chris? Would you take a wild guess? That is gold.
Gold.
I
Okay.
didn't give you the opportunity to take a guess, but look at that. So for the investor who was diversified, if you had bad timing and you purchased in 2011, 2012, you had little returns over this period of time. But if you've dollar cost averaged into it over time, you're in pretty good shape. And if you look at that compared to other asset classes, it's not outperformed the S&P 500, but for a brief moment in early 2020, it did. So you can see, look at what it did during a period of chaos, and from 2019 to the COVID market drop. That's not necessarily what I would expect during a market sell-off, but that shows what gold can do during a period of time like that. And I think I have one more chart in here that goes back,
Oh, that's a beauty. Look at that purple line. That is a cup and handle.
Yes.
That's extraordinary in technical terms. Can you explain a cup and handle to people real quick?
So a cup and handle technically is basically you get a market sell-off, and then it starts to sell off again, and then you build this little handle over here. Let me see if I could probably draw one on the screen. No, I'll have to change a few things. But that's a long-term bullish pattern that if you break out of, it's the psychology behind investors, sold this rally thinking that we're going to see a decline, but you get a series of rounded bottom that looks like a cup here. This would be the top of the cup. This would be the bottom of the cup. Then you get this handle. And that's a psychological pattern that once executed, when you break out of the top side of what would theoretically be the top of that cup, it can give you some indication. I can't remember the calculations because I reference it, but it gives you an indication that you're going to see a much higher price. So,
and I'm even looking at the larger cup and handle, that big one. That big right giant here. One. Yeah.
The longer time frame that occurs. And actually, this one is a lot more clear there than what this is on this side. So you've got this sell-off, you've got a rounded bottom, you've got a retracement. I'd love to actually overlap this with Fibonacci retracement just to see what numbers we hit, but you come up this way, and then you've got investors that are, and you think about this in context of gold, right? Where do you turn on the TV and hear any positive news about gold, right? It's at the fringes, what the mainstream would consider fringes of society, because they're losing their hold and we're stepping up. But, those who are really looking at the data see it. So in the midst of all the negativity for the average retail investor on gold, and you've got this massive cup and handle pattern. The upside would be, I hate to give any targets without talking to somebody, but the upside would be up there a lot. Let's put it that way. But again,
Yeah.
going back to
And
gold, Chris. Sorry, go ahead.
yeah, well, I track this like a hawk. Gold is an area I know a lot about, and I follow a lot of people who are on the inside. So this is a funny thing, Paul. If I wanted to, I could find out really what you would consider to be amazing, like state secrets about our military before I could tell you how much gold actually still exists in Western vaults. It is one of the most carefully guarded secrets.
It shouldn't be funny.
So we have to peer from the outside and sort of guess. And so I track things like shipments through refineries in Switzerland and how many kilobars are headed off to Asia, mostly China, and so on. There's been a massive flow of gold from west to east. Mm-hmm. We don't know exactly how much, but it's pretty staggering and significant. And we saw a lot of it really that ramped up some by the tracking through the smoke signals. When it hit the top of that cup thing, remember at 2000, there was this huge battle to try and keep it under 2000 because for whatever reason, Wall Street, Federal Reserve, the BIS, who knows, but the Western interests, they don't like the big round numbers on gold. There was a big battle at 1,000. I remember a battle at 500 because I'm that old. I remember these battles. So, but those battles are costly because, they play their paper games and their tricks, but fundamentally it does cost them some physical, and a lot of physical has gone over from west to east. Prediction. Someday they're in self-interest alone. We're like, that's it. We've scraped the bottom of the barrel and we can't do this anymore. And I think that's when the game that we break out of that cup in a significant way because the shenanigans have to stop, and then we have to get back to real pricing. Again, the pendulum swings. Fantasy back to reality. Us gold bugs have been waiting for reality to bite for a very long time, but I think we're in the early stages of that, and we're seeing it because it's harder and harder for these interventions to sort of stick,
Right.
and keep the price down.
Well, and one comment before I go into another thought, I don't think that gold that's left the West and headed to the East is ever coming back because I don't think that Western institutions and investors are going to have enough capital to pay the price that they're going to have to be able to pay to bring it back. And furthermore, you've got the risk that those countries could institute export bans on that gold and just say, we're not going to let it leave the country at some point. So, that's a concern that I have from an overall standpoint.
Editorially, just to add on to this is funny, right? Wall Street hates gold. You read articles in CNBC and it's just like barbarous relic and they trash on it. And if it ever goes down, they have articles written by AI instantly to talk about, how bad of an investment gold is, all that, right? So on the one hand, it's this worthless thing that it's ignorable and it really has no place in a portfolio. But at the same time, it's too important to actually get a public audit of the public's gold to find out how much is actually still in the vaults. Trust us, it's all there. No, you can't see it, right? And I'm like, well, why, if it's this irrelevant, why not just open the vaults and we'll just count? It's very simple. An audit of bars is as simply as counting them and drilling a couple to make sure it's the purity you think. It's very simple.
Right.
Haven't had one since the 70s, allegedly, and even that one was a little suspect. Like, we'll open this one door. It's all there, see? So why all this secrecy if it's this unimportant? That's the mystery.
I agree completely. And the other side would argue, why do you want to be secret if you have something to hide? But we're going to project that onto you, but we're going to give you all kind of reasons why we can't. We have some things to hide. So
it's a matter of national security that's totally unimportant. It's
right. So,
all right.
Let's just talk about, just kind of finish that gold train just a little bit. Okay, there's no perfect asset class, but when you're talking about insurance, gold has a couple of things to offer that other asset classes don't. So, Chris, one of the things that I could not say, I do believe that we're going to exit this in a extremely inflationary manner with potentially a currency crisis. So I've spent a lot of time building strategies, put them on the shelf. When we cross certain thresholds or decision points, I've spent the time doing the research so that we can plug and play those approaches. We spend a lot of time talking to the people that we run financial plans for. Okay, this is what happens to you If we have really high inflation, so if we cross this threshold, this is the strategy we need to implement so that we're ready, right? Because I'd rather spend the energy now preparing because it is a highly likely outcome. On the other side of that, we also can't say that we're already in the midst of all of this asset price inflation and that we ultimately have a deflationary event like occurred during 1929 because debt levels are so high, we have a deflationary event. So, look, I'm going to pick on Southern Company because it's in the South. Now, not a recommendation, but they're a utility company. They're under regulation. They've got protected competition, right? So it's highly unlikely that Southern Company's ever going to be a company that goes bankrupt. But if we had a great 1929 type great deflation, okay, it is a risk that a company that has any debt levels could go bankrupt. Well, the good thing about gold, if you hold physical gold, gold doesn't have a creditor, okay? So if we have that big deflationary event, yes, gold is going to drop in price, okay, because you have deflation, but you don't have to worry about losing that gold if it's held in the correct manner to a debt collapse because it doesn't have any creditors behind it. It doesn't owe anybody anything. So the fact of the matter is you still have purchasing power if you own gold versus a theoretical bankruptcy of Southern Company, for example, or any stock that's out there. So it does offer some insurance protection for investors across the board, against worst case scenario, because if we did have that big of an event, the fact that you have any assets, right? You don't have to navigate it perfectly. The fact that you have any assets and that you're not encumbered by debt and you can still maintain the assets that you have, that means you have purchasing power that a large majority of the population doesn't have right now. And that means that you and your family can navigate it better than the average person. And if you've prepared good enough, you and your family and extended community can navigate it better because you're in a position to take advantage and purchase assets and turn them into income producing assets that other people can't.
This is a great point. So many sparks are going off. So when you hold gold, it's a monetary asset. The BIS says that the Bank of International Settlements is considered what's a tier 1 asset. So it's as good as cash, right? Yeah. Within the banking system. Now, here's the fun part. When you hold that monetary asset, gold has one feature that nothing else in the financial universe has, which is that you can hold it and it is your asset, your financial asset, and it is simultaneously nobody else's liability. Mm-hmm. I hold an asset. It's a U.S. Treasury bond, my asset, their liability. Mm-hmm. But even these things we call cash, it's a Federal Reserve note. It says it right on there. It's a legal contract. You should read the writing sometime. I invite everybody, pull a dollar bill out or a 20 or a 100, read it. It's a contract. Mm-hmm. This currency is valid for all debts, public or private. It's the Federal Reserve note. So it's their liability. Your asset, their liability. Okay. So you say we could get into this punishing deflation. If we do, I'm going to argue here's why we're not going to get into one for very long. And that is, I'm going to get to myself to this sharing my screen, and I'm going to have to pull up my favorite one. So I've just pulled this up. This is TCMDO, total credit market debt outstanding at the Federal Reserve. This is debt, federal, state, private, not unfunded liabilities. That's different. Social Security being in a shortfall and all that. Just debt, straight up debt. Woo! This little period right here was the only time in history that debt went backwards. That's 2008 through second quarter 2010. Went down for those 6 quarters. That almost blew the system up. So they learned their lesson, like, let's not do that. And of course, debt's been on a rocket ride, but look at this number now. What do you see? I see $96 trillion of debt. If that starts to go into what you call a deflationary episode, it's lights out. Like the whole system implodes. Like it literally breaks. And that's what they're afraid of. And I trust when people are afraid of things, Paul, I don't see how we can go from, like, with $96 trillion of debt in the system on a $30 trillion GDP or whatever it is at this point. of which 10% of that is actually government excess.
Right.
I don't know. I don't see how they can afford to allow a deflation to ever start. It might start, but they will move heaven and earth
Yes.
to prevent that from going any further. And what does that mean? Very simply, they'll print.
That's right.
And how much will they have to print? I don't know. Lots.
Lots. They're going to have to print lots. But at the same time, I like to go through the exercise when we look at that, when I have the conversations with individuals and say, okay, one statement you made that is if we get into a debt deflation spiral, that's it, lights out, right? I mean, you're talking about federal government bankruptcy, you're talking about corporate bankruptcies, you're talking about really bankruptcies on a global scale, which is truly an absolute reset, right? And it'll be nearly impossible for even a prepared investor to hide from that. But again, going back to that one asset that is not somebody else's liability, that doesn't have any creditors on the other side, is gold. So I'm with you. I think we're going to have a deflation episode. I think now it's possible that they're so scared of that they don't even allow it to happen. That's kind of a nightmare for investors, because you're pinned to the wall and you just have to embrace risk. Hold your nose and embrace that risk, right? But if they take that path where they keep it pinned to the wall, then commodities, emerging markets, other asset classes are going to take off. So at least you have somewhere that you can reduce that risk and have an outperformance capability. But if it does spiral out of control and we get worst case scenario and you have some physical gold that you looked at like insurance, again, I'm laying my argument, but I'm not making a recommendation. Those of you listening have to call me or talk to a financial advisor. You've got to talk to a professional about this or we get in trouble. I got to disclose that. So, but if you're holding that physical gold and you've looked at it like insurance, hey, I'm taking a portion of this asset class that I'm setting over here that I'm going to hold physically. I hope 10 years from now it's the same value that it is today, right? When you buy fire insurance on your home, you don't get 10 years from now and go, dang, I wish my house had burnt down because I just wasted all this money on fire insurance. No, you have it there as insurance for a catastrophic situation. So that's one of the reasons why, regardless of where the price is today, for those, if it's appropriate for your plan and if you have an emergency fund in place and if you're, and you've talked to a professional that can explain the reasons why, it does make sense to allocate a portion of your liquid assets to physical metals that you hold as insurance against worst case scenario. And the added benefit is, Chris, if they print that much and the BRIC countries are utilizing gold, they've been buying it for a reason, and maybe they introduce a quasi gold backed, percentage gold backed currency, well then guess what? Gold is going to go through the roof too. So if we get either extreme, that insurance policy can pay off really well.
Absolutely. And I talk to really substantially wealthy people on a far too frequent basis who have zero exposure to gold, right? It's astonishing to me, right? Because you just look at all these macro features and you go, okay, this is just insurance policy. And by the way, it's an insurance policy. I will guarantee you, and you can make very few of these in the financial space, it won't go to zero. And I'm going to base that on 6,000 years of history. Gold has always had some value. It might go down in what we see as a relative price, but I can't find any period of history where it went to zero. So, that's sort of like at least you know that much, right? Your fire insurance policy may expire after having been just a net cost and go to zero, right? In essence,
right. That's right.
But it's one of those things where, I call it an insurance policy, but it's more than that, because it has one other feature that I want to talk about. It has an embedded call option in it. And so for people who don't know, an option is a thing that has a potential value if something happens, right? And a call option is saying, if this thing really goes up in price, I'm going to have that call option. A put option is betting something will go down in price. But the call option that's embedded in gold is this, which you just referenced, which is that it's a monetary asset. It's not really part of any monetary system, but if it gets remonetized, and this could be a very small probability event, maybe it won't happen. We'll use cryptocurrencies, digital assets instead. The world won't go this way. But it's a non-zero possibility that it may get remonetized at some point. And then you have to pick some crazy numbers like, what would it be worth? I don't know. How much gold is there? How much currency's floating around? Divide one by the other. You get stupid numbers, right? You know, I've seen numbers 100,000 an ounce, whatever, just dumb. But it's non-zero that gold gets remonetized. So holding it actually has an embedded call option most people aren't aware of. And it's a very low, it's like buying a really out of the money call option, 10 years in the future kind of a thing. It's like very improbable this will pay off. But if it does, it has that embedded value. I don't think that's priced into gold at this point. I don't think most people see it that way.
No. And if I remember correctly, going back to the peak that occurred in the 1970s, gold reached the point where it was worth more than all U.S. dollars in circulation. I'll get bearish on gold priced in U.S. dollars when it's worth about 20% more than all U.S. dollars in circulation, and that number is ridiculously higher than where we are right now.
Yep. Yeah.
So,
yeah. No, I like it for a lot of reasons. People ask me too, are you concerned that it'll be confiscated? It was in 1933, right, by Roosevelt. But at that point in time, gold was money. It wasn't confiscated because it was gold. It was confiscated because it was money. It was the only legal tender actually behind it. So that's not true today. So that's a slightly different thing. You know where I get scared though, is when at some point in the future, the few remaining oil exporting countries say, I don't care what the price of anything is. It's this many grams for a barrel of oil. Of grams of gold. Yeah, and the price is irrelevant. It could be 5,000 an ounce, 50,000, $3. We don't care. We want 3 grams for a barrel of oil. And that's the end of it, right? At that point, I get worried because now you have to have the stuff if you want to get oil. And I could see governments doing what governments do under that scenarios. But beyond that, I don't have a lot of concerns that it's going to get reconfiscated because it's not money. No,
I'm not necessarily concerned about that either. I mean, you could build the argument that if we had to compete against some type of quasi gold-backed currency in the BRICS, that could happen in the U.S. But there's an easy way to solve that problem from my standpoint. Now, it's not perfect, but this is something I've thought about. Well, if you're a U.S. investor, buy Canadian maple leafs, right? 99.9% pure 24-karat gold. Well, you've got the added benefit that if unless they confiscated all gold and you're ready to give up your jewelry, I mean, I guess they could put levels in there. You've got a little extra protection against having to turn in your American minted coins to an American government. And theoretically, right, I was going to say, if you're a U.S. citizen and you melted down those coins into something else, which is something you're not supposed to do, so I can't recommend that. The jurisdiction doesn't necessarily have the ability to pull you out. Maybe that changes. I don't know. But there are a few things you can do if that's something that concerns you to give you a little peace of mind.
And you mentioned them before, but I do like Goldcore. They're a company that Peak Prosperity has a nice relationship with, and we really admire and love each other. And we do have an affiliate relationship with them. So understand in full disclosure, but I like them. I like them a lot, and they have a really great product, and there are a number of companies that will give you similar exposure, and it's this, which is I have some of my gold stored out of the country in countries that I consider to have jurisdictionally, it would be difficult to seize that. Not impossible, no guarantees, of course, but you got to spread your bets around a little bit. So, if you have some of your gold held, just making a number of, if it's in Switzerland, they can't seize it. And the Swiss people have this thing where they have to have a supermajority referendum vote in order to change the law that would allow them to do that sort of a thing. That's the kind of thing you can see coming from a long ways off, because they have to propose a new referendum law, and the people have to vote on it. I mean, these are all things that would give you time to adjust if it came to pass, but I can't see that happening either for a variety of reasons. But never say never, right? So these are all things, unfortunately, we have to think about in this environment now. It shouldn't be this complicated, right? We should have more trust that we're all in this together, and it's not sort of an us versus them. I have to protect myself from some grabby people, but this is kind of the story of history, isn't it?
Yeah, it is.
Empires get a little over the tips of their skis, get a little too complicated for their own good, make too many regulations. They kill the golden goose, and then they just throttle that goose right to the end, you know?
They do, don't they? If we continued to see the introduction of free markets, it would make a big difference. But we're not seeing free markets right here. Free markets
Yeah.
are where we can thrive.
Yes.
Controlled markets and centrally planned markets just haven't worked out throughout history. You know, the U.S. didn't get here by being a controlled market. It was a free country and innovation but then you've got the asset class come in, choking the neck of the golden goose. That's well said, Chris.
Yeah, well, I believe in people. I believe in free markets. People are amazing, creative, wonderful things, but regulated markets are the opposite of all of that.
Right.
That, you know. So,
So,
yeah.
I do get a lot of questions when we're talking about gold and precious metals because people ask about what about silver? What about platinum? Now, I really like those, but in the context of what we're talking about, gold is kind of your insurance. Silver would be a little bit more of insurance plus speculation, and platinum would be kind of speculation on steroids. That's just a way to think about them. So you got to think
Yeah.
about that standpoint.
We should do a special episode sometime and talk about these because I actually love these and many other commodities, copper, oil,
Yeah.
because of very fundamental supply demand mismatches that have happened for a lot of reasons. And I think it's, again, one of these things where there's a lot of what they call alpha. There's some real intelligence in here that we can look at that I think most of Wall Street's overlooking because they're just fascinated with their financially sophisticated shenanigans, right? But there's some fundamental things going on that we should have a longer conversation about because of just, you know, depleting stocks of these things and how long it takes to open a mine and yada, yada. We have astonishing supply-demand mismatches that even, you know, JP Morgan and Goldman's commodity desks are over there actually screaming about. They're like, we're short, like we're short this stuff, right? This is a thing, right? And everybody's like, who cares? You know,
Yeah, you're right.
currently.
So, and the sad part is just the incentive of Wall Street. So when all that anybody cares about is beating some index, and now you're a mutual fund money manager and you're having a hard time keeping up with ETS because your expense ratios are a lot higher. Guess what? The C-suite fires the guys who aren't outperforming the index, so you end up having a bunch of mutual funds that are mimicking the index because they want to keep their job at all costs. So why in the world would you know, if you're a professional money manager and unless you're mandated to be able to go into that category, and if you're mandated, your assets haven't grown a tremendous amount just because of the fact it's not a popular place. You know, the whole structure of Wall Street right now is set up to chase what's working until it blows up. And the big professionals are going to use, I believe, you know, the media sources to offload their shares onto the average retail investor who just doesn't know, right? I mean, and this is what I get all the time. That this reminds me, you know, you get these phone calls, and I have them come in every now and then. They don't call me much because I think I've burnt all of them up. But they'll call me. They're like, "Hey, Paul, you know, we've got this great stock that we need to unload. You know, that I say unload. That we need you to look at and buy for your investors. It's a great return." And I'm like, "Okay, look, there's a thing called insider trading, right?" And he's like, "Yeah." I'm like, so do insiders tell everybody what they want to buy? You know, I mean, you're not going to call me. You're wanting me to offload this onto my clients, and I'm not going to offload your junk onto them. Well, then now it goes to the average retail investor, and they're like, hey, you know, this is the greatest stock you can buy through an email. I'm like, look, somebody's spending a lot of money trying to offload these shares to you. In a lot of cases, now there's good publications, right? But I'm saying the large majority of them is just firms that are designed to offload these thinly shaded traded shares for big institutions that have large amounts of them, and they've got to get out. That's just what the retail investor has to deal with today, and that's why strategies are so important to help you determine what you need to buy and when you need to buy it and when you need to sell it. You're frozen on the screen, so I don't know what happened. I don't know if you're out. I'm going to step away for just a minute. It says it's still recording.
Hey, Paul. Sorry, my computer crashed.
Oh,
We'll just
I was
keep
gonna
going.
say- Okay, good. I was stepping away for just a second. I was going to go to the restroom, but I'm sure you can edit that out somehow, right? Because it was
Yeah,
still
yeah,
recording
yep.
on my side.
Yep. No, your side will be flawless. We'll just edit out this little gap that happened. I'll see. Mine may have lost a chunk of that. So
Okay.
so
But
what I would say
mine should still
is
upload, right?
yeah, mine was like 98% uploaded. So we'll lose a tiny bit. So where we would start would be, hey, I get these calls from people wanting to offload.
Yes.
So start there.
Okay. 3, 2, 1. So I get these calls from these firms that from time to time that are like, "Hey, Paul, you've got this is a great stock. This is something." And my first question is, well, who's the largest owners? Is it institutions? I have fun with them for a few minutes, and then I'm like, okay, there's this thing called insider trading. I'm not saying that's what we need to do. You can go to jail for that. But insiders don't project their information to the world because they want to have an advantage over. So the reality is the only reason they're calling me is not to sell me a research service. There are good research services out there, but they're trying to offload shares. So one of the things I see all the time is individuals will call me. I'm like, okay, where'd you hear about this from? These massive email campaigns trying to offload shares. So we see it from emails. We see it trying to do it to professionals. They're playing on greed. And now I really believe we're seeing it in the efforts of the media to say, hey, this is, without saying it, this is a new permanent plateau so that they can offload to the average investor. Now, they may be rewarded for 6 or 12 months. But it's hard to see it lasting much beyond that with the economic data that's deteriorating and continuing to deteriorate on the surface. Some's held up better. That's what the market's excited about. But it's still deteriorating. So the question is when does that deterioration continue to accelerate? Because by most historical measures, we've been in a recession at this point with the economic data.
Well, we have, and I'm old school. I think recessions are a good thing, right? It's part of the natural process where you got to clear out the dead wood, right? And I really decried like 2008, 9, right? Remember all the heroics that the government went through to stop Government Motors, GM, from going under. Listen, it would have been very disruptive, but you know what would have happened? Better, well-run, more nimble companies would have stepped into that vacuum, and lots of jobs would have been created, and we might have better products. I remember when people are like, oh, Elon can't compete with NASA. Takes a government to go to space, right? That was the story. He was like, yeah, I don't believe your story, right? And now we have private industry taking us to space and, giving us things like Starlink. Again, it's just been amazing watching what happens when entrepreneurship comes along. That's what recessions do. They just give entrepreneurs an opportunity to come in and give us better stuff. So this whole stopping recessions from happening, which they've really taken on as their central mandate, we can't let down ever happen, is actually unnatural and it's counterproductive. And I think that's part of why they're afraid of allowing a forest fire to start in a deflationary sense, is because, well, it'll be a crown fire this time. So much dead wood is built up, right? 18% of U.S. companies are zombie companies. They can't meet their debt payments from operating income.
That's right.
What happens? Can we let that many companies go out of business? Well, you better, because they're not doing anything, really,
Yeah, we should. And it goes back to that analogy between controlled burns versus no controlled burns whatsoever. Recessions are controlled burns if we allow them to happen. And but now we're in a situation where they put this off so long, they put so much effort into kicking the can down the road. Like you said, 18% of the companies that are out there, that's not counting the ones that are borderline as well. So if this fire starts, it's going to get out of control and dramatically upend the underlying economic cycle. And to kind of go back to one more chart that was in Hussman's market comment, he goes and points out the index of leading economic indicators. And I forget that my mouse doesn't show over here, but if you go back and take a look at 2023, so this is the 12-month percent change and the 6-month smoothing of annualized 3-month percent change, just trying to take a little bit of the noise out of these leading economic indicators from the conference board. He points out, and he states in there, this is the lowest level that we've seen going back to 1960 without a recession, right? So,
Yeah.
That just shows. Now, I guess it's possible this is the point of which we typically turn, especially 2000, 1990 when we had that in there. So, but it looks like, especially on the 6-month, that it's trying to turn back down again here in 2023. So, this is still a tedious environment. My question is, are we going to get down the road and look back and go, oh, we're going to revise the data? Actually, yeah, we were in a recession, but we printed enough money to get out. It's just a hard environment for investors to navigate.
Well, it sure is. So, hey, we're going to have to call it there for today. But Paul, thank you so much for your time again today. Anybody who wants to get an analysis, a free financial analysis, a plan even from Paul and his team, please go to peakfinancialinvesting.com, fill out a very simple form. Somebody from Paul's team will get in touch with you and help you make sense of this nonsense. So, Paul, thank you so much for doing that, and really valuable service you provide. Just love working with you and getting your insights here today.
It's my honor, Chris. It really is.
Hello, Chris Martinson. I'm the CEO of Peak Prosperity and also Peak Financial Investing. And after watching that, you're probably wondering, well, what do I do with my money? Look, you both deserve and need somebody who can talk to you about what's really going on in this world, understand the situation as it is, not be steering you towards certain things that don't make sense for you, or just keep you in a game that's already ended. Look, if you want to talk to somebody about the petrodollar declining, or what is happening with gold, or which sectors are actually the best ones to be in, given what the Federal Reserve is up to or the federal government, you deserve to talk to somebody who can answer those and has a few gray hairs and has been there through some of the economic cycles, because, hey, we're in another economic cycle, so it's good to have that experience. Fortunately, at Peak Financial Investing, what we do is we go out and we scour and we look for the very best firms out there who satisfy one thing above all else. They've got great experience coupled to great customer service. So if you want to come by peakfinancialinvesting.com, there's a very simple form you can fill out, just a few fields. You hit send. What happens is an email gets triggered out. It goes to an endorsed firm of ours. You will get an email back. You can then set up a phone call for a 30 to 45 minute free, no obligation, no pressure call to find out if this firm is a good fit for you, and to find out if you're a good fit for the firm. It has to go both ways. And if all that matches up, this will be one of the best things that could happen to you this year. So please come by peakfinancialinvesting.com. Very simple process. We would love to help you if we can. Thanks very much.